welcome back to this week's market update. Today is Monday, March 17th, 2025, and with that, we'll jump right in. Taking a look at last week's market performance, it was a bit of a choppy week with the S&P 500 actually hitting a technical correction down more than 10% from its recent high there. We ended up with the Barclays Aggregate Bond Index just about flat, while on the other side, equities were down. So we saw the S&P 500 down 2.3% following the bit of a bounce back on Friday. We saw the Nasdaq down about 2.4%, and then the Dow Jones Industrial Average down at just more than 3% last week. Diving a little bit deeper into the idea of a correction, because it is significant, right? A pullback of 10% or more on a major index, that is significant. We definitely want to be aware of it, see what's driving it. Right now, it seems like there's a lot of economic worries, a lot of slowdown concerns over tariffs, those sort of things, a lot of emotion driving the markets right now. But looking at the point and figure chart for the S&P 500, if this longer term trend continues, you can see it's really been a positive trend since late 2022 here. Overall, we've been in a bull market. This looks like it could be a healthy pullback. And so if that is the case, this looks like it is near a bottom. It might be at the bottom. It might have already made its bottom. Or maybe, in the next week or two, we could see a little bit of a downturn and it trades in this range here. But if the trend holds, we should see a bounce back. So just some perspective on what the technicals look like right now. Again, this is just one of many indicators that we take a look at. But if this trend continues, we hope to see a bounce back in the next week or two. Looking at our regular economic data from last week, it was a CPI week. So we got the February CPI as well as the PPI, Producer Price Index there. We saw February inflation come in at 2.8% on an annual basis and core CPI at 3.1%. So a small downtick from January's numbers, lower than expected. And hopefully this is the continuation of inflation starting to settle below 3%. As you can see, we had a few months of rising headline inflation since about September of last year. So with that, we'll take a look at the categories in the next slide. Now, looking by category, this headline number, as we said, 2.8%. But what really matters is what are the underlying items driving that increase in inflation. So on a month-over-month basis, inflation rose 0.2% on both the headline and core measures. We saw things like food moderate quite a bit after a few months of higher inflation, so that moderated to an annual rate of 1.9%. Other categories like energy were down from a year ago, up slightly in the month. Gasoline was down just about 1% and down just over 3% from a year ago. New vehicles and used vehicles continue to see very low inflation, although we did see a small spike in the used car inflation rate on a month-over-month basis there. Other categories like transportation and shelter have been quite sticky. These are some of the largest components of the CPI equation, and so having 4.2% shelter inflation still quite high, as well as the 6% transportation services inflation. In addition to the CPI, we also got the February PPI, Producer Price Index here. So it came in at an annual rate of 3.2% and core PPI at 3.3%, both moderating from December and January's figures. On a month-over-month basis, prices actually did not increase at all. And then on a core PPI basis, prices were up 0.2%, and this excludes volatile food, energy, and trade categories. Overall, it seems that goods were the largest source of inflation in the month of February, although we did see overall flat inflation. Categories like foods were up 1.7% in the month, which is quite a large jump, offset partially by lower energy prices here. But other categories of goods were up 0.4%, which ultimately led it to be up 0.3% in the month, while on the other hand, services were down 0.2% in the month. So goods seem to be driving this most recent leg of inflation. On Friday of last week, we also got the University of Michigan's Consumer Sentiment Index. It showed a 10.5% monthly decline from February and a 27% decline from March of 2024. So consumer sentiment definitely dropping. Now, this is not always indicative of how the real economy is. Many times consumers will say one thing and do another. They'll say the economy is really bad, but we see retail sales continue to be strong. So it's not necessarily a completely accurate indicator, although it is important to understand and be aware of and monitor. Looking at what was driving consumer sentiments drop in the month of March, higher expectations for unemployment, inflation on the short term, and inflation on the long term were really some of the key reasons for the rise. You can see unemployment expectations rising sharply. We have nearly 70% of consumers expecting more unemployment in the near term. Inflation expectations for the forward year ahead also rising, and then long run inflation expectations also rising, just at a bit of a less steep pace there. Last but not least, while consumer sentiment has weakened, several of our economic indicators point to stable to positive economic conditions overall. So taking a look here, you can see we have three neutral indicators, and then we have three bullish indicators and two bearish. So overall, three bullish, three neutral, and two bearish leaves us with a slightly bullish tilt to our overall economic outlook, at least according to these indicators so far. So the market is forward looking. They're looking at the risks of tariffs, they're looking at the risks of inflation, potentially higher unemployment, and those sorts of things. But given the data we have right now, we have not seen those quite yet. So this last bit of a sell-off, as we looked at in the correction slide in the beginning, does seem to be maybe a short-lived market cooling period, and hopefully we'll see that bounce back in the next few weeks. It was a very busy week in the markets last week, and this week will be the same with a Federal Reserve meeting on Wednesday afternoon. It'll be really important for the markets. So thank you so much for tuning in to this week's market update, and we look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.